Joining us now for a dive into these markets, market reaction to the geopolitics, but also, of course, the central banking action, is Dryden Pence, Pence Wealth Management CIO. Dryden, I just wonder, given where we are with geopolitics, Iran, North Korea coming through as additional risks over the last couple of days. Of course, Russia and Ukraine have been there. The US and China remain, of course, a period of tense relations between the two sides. What for you is the most important fact? Is it geopolitics or is it the Fed at this point?
I think it's still actually the Fed. When it gets right down to it, in the United States, it's driven by interest rates, inflation, and the Fed for things in this particular market. Geopolitical risks are there, but I think that when we think overall for U.S. markets anyway, it's still driven by the Fed. And we've really changed the narrative over the last couple of years in what people are looking at because we have higher interest rates now.
What is your conviction then on rates, terminal rates at between 5 and 5.25%? We were speaking to Goldman Sachs earlier, their chief European equity strategist. She was saying, Sharon Bell, look, she sees potentially up to 5.5%. You have conviction around 5 to 5.25%. What is underpinning that?
The reason why is there's lag effects that people are not fully taking into account here. And so the two big issues is that it takes a while, 4 to 9 months for lag effects to work through. So we really haven't seen the last 150 basis points of the raises that the Fed's already done work their way through the consumer part of our economy. So I think that there's going to be desire to kind of wait and take it a little bit slow because I think we've got a little ways to go. The last 150 basis points probably haven't fully shown up yet. And I think that's part of the reason why we're on this 5.25 as a terminal rate. And then they wait, and it's higher to longer. Yeah.
What gives you the confidence that inflation has turned, Dryden?
I think when we take it's easy to go from 9 to 5, hard to go from 5 to 2. Yeah. So inflation's turn, we're directionally in the right way, but I think we're going to go through a period of time that it's going to be very sticky to move lower just because the services sector of the economy, supply chains have evened up, opened up a bit. That's all getting better. But I think that directionally we're right, but the rate of decline is going to slow down here. But I think we certainly are past the peak.
What is your regional preference at this point? The PE discount of Europe versus the US is attractive to many. Do you align with that view?
Well, I think as we get later into the year, Europe becomes more attractive to the U.S. But right now, I think there's two big things. If you look at asset allocation standpoints, for the longest time in the United States, it was a TINA market. There is no alternative to equities. And now we call it a baby market. And that stands for, in American vernacular, bonds are back, y'all. And you can get a 4.6% on a 2-year. That really changes how investors here in the United States begin to look at long-term asset allocations.
And on that point, of course, 6-month paper for 5%? Cash is back, arguably, with rates at those levels. What is your bias then in kind of portfolio composition?
Well, we're still in the shorter part of the curve on fixed income, but we actually like also healthcare, defense, companies around payments. And luxury goods. I mean, the consumer, U.S. consumers spend money, and they have a lot of money, and everybody has a job. So when you think about that, we look at luxury goods as being an attractive place as well. And then back to your thing, we think Europe gets attractive to U.S. investors in the latter part of the year.
Okay, Europe becomes attractive in the latter part of the year. What is the China view from you? Goldman Sachs again giving and putting out a note suggesting you could see further upside of plus 20% for Chinese equities. Do you want to have direct exposure to China? Well,
we invest purely through ADRs, but I think the key thing is China is opening up. And there is opportunity there, but one has to be very, very cautious because it's not a pure linear move in China, and there's still a lot of tension going on there. But China opening up is a big deal, and there are opportunities going forward.
Just briefly before we let you go, your views on investment grade credit. Is USIG looking good?
We like things in the United States. We really do, because basically our economy is quite strong, and that's one of the good things about it. So I think we see consumers have money, consumers have jobs, and they're going to spend it.
Okay, there you go. The preference for US assets at this point. Maybe second half of the year you start to look to Europe. Thank you very much indeed for your insights. Dryden Pence, Pence Wealth Management CIO.